Hello everybody, Jackson here with the Wealth Squad. Today we'll be looking at a resource to use and analyze the stock market. We're looking at multpl.com, multiple.com, and it's a free resource that basically just looks at the averages of the stock market, and we can see the past up until, this one shows up until 1870, which is pretty dang crazy. But you can analyze stocks and look just as far back as then. That's pretty useful, right? We're looking at the PE ratio for the entire S&P 500, the highest quality 500 companies, and we can see we're at a 24.39, a peak of, I'm assuming, the depths of COVID when earnings were very, very, very low and prices were relatively high still, just because imagine um, imagine stores like Dave and Buster's or airlines where their earnings disappeared overnight, where people cannot um, almost cannot like even use them, or golf places, right? Stuff like that where it basically stopped production. Um, and that's when prices dropped, earnings dropped even more, so the PE ratio rose. Now we're looking at 2010, 29. You can see 2009, 2008, the crash brought prices really dang high, up above 65 where we can't even see them. And then in the 2000 and 2001 tech bubble, we see prices PE ratio of 40 to 45. So right now we see 24.39, an average high, but considering the last 30 years, not so much. So let's look at the Shiller PE ratio, which is said to be the stock market crash predictor, right? Warren uses this ratio like no other, where he invests based off where the Shiller is at, right? If it's high, then he likes to, maybe not go so aggressive, and vice versa. But we can see here, Black Tuesday 100 years ago was at a 30, and then it tanked, right? We can see Black Monday 1983, or looks, oh no, 1987 was a 17, and then tanked like 20% some percent in a day. And we can see the early 2000 bubble where it was a 43, 44, and that is, the higher it gets, the more of a sign it is overvalued. That's what the Shiller is telling us. You see right here, price earnings ratios based on average inflation adjusted earnings from the previous 10 years, known as the cyclically adjusted PE ratio, CAPE ratio, Shiller PE ratio, or PE10. Uh, Whatever you call it, it analyzes the same thing, right? The PE ratio on an average inflation adjusted. That's what it measures, right? P ratio on an average, which happens to be inflation adjusted. So we can see right here we are at a 35. Over time, the market has only been higher once, and that's in the year 2000, 1999. Is this a good sign? No, it's not, right? It's not a good sign. If the lower we see it, the better. The better it is to invest in. The higher we see on an inflation adjusted period for the PE ratio in the last 10 years, it is relatively overvalued based on that fact. Um, a 35, not too good. In fact, we've only seen it once or twice before, back in 1999 on the ascension and descension of the speculation bubble bursting. So look into the Shiller PE ratio. You don't want to just take it for what I say. You want to look into a little bit more if you want to base some serious information and decisions off of it. We could look at some others, but that's mainly what I wanted to talk about: the SP 500 PE and the Shiller PE. We look at Treasury rate. We see 1.94%, relatively low compared to the past. Then we see the dividend yield, which is also relatively low. So if you did not know, back then we had yields of 5 to 6%, as, or not necessarily, that was a long time ago, that was like 50 years ago. But the dividend yield has been decreasing over time. Dividends have become less popular. You can see in the past, like 6 to 7, 8% would be your normal dividend stock, right? Then 5%, then 4%, now 3 to 2, and now less than 2. We're at 1.41% as an average. Well, you got to think of the top 5 stocks that are in our market, right? We have Apple, Microsoft, Google, um, Berkshire, and Tesla may be up there. Out of all those, Microsoft and Apple pay a dividend, and out of those two, the dividend is very, very small, right? So that's where our average is so low, because the biggest companies don't pay dividends. They barely pay dividends. You have to take that into account, right? ExxonMobil, sure, a top 20 company and it pays a big dividend, but the other 19 or so really don't. That's why dividend yield is so low on average on this site. And then earnings we could see at an all-time high, which is good because you want to be making more money than the last 20, 30, 40, 50 years. Even if it is inflation adjusted, we are seeing higher earnings than ever before, and that's a good thing. So you have to look at the positives and the negatives. Positive, we're earning more than ever. Negative, dividend yield has never been lower. PE ratio, the Shiller PE has only been higher once or twice, and the standard PE ratio is lower than the previous bubbles, but still relatively high compared to the past. So take this into account what you will, right? Information can only be so reliant before it gets into speculation, and take it with a grain of salt if you'd like. It doesn't have to change your investment strategy right away. Keep it in the back of your mind. So I hope this video helped. You could go check out multiple.com. It's free and easy to use. It just shows the averages of a whole bunch of reliable and useful information. And we can see right here, it does a lot more than just PE ratios. So use this. It's a free, easy resource. Spend a little time looking at it. And yeah, that's the video. Thank you for watching.